Okay, this is our lecture for Chapter 2, the review of the accounting process. This is one of the critical chapters in intermediate accounting, so you may need to review this chapter and this lecture a few times because this is a pivotal point in accounting. This should be a review of what you learned in Accounting 201, but we're just going to go over it again and in more detail and just go further in depth in a lot of the accounts. So basically, we have economic events that causes changes in the financial position of the company, mostly cash. Those events can occur inside the company or outside of the company, which is probably the most typical. We like to refer to these external events as arm's length transactions. And internal can be within another entity or a related party. And we will learn more about related parties as we go along. So the accounting equation, I like to refer to this as ALO. Assets equals liability plus owner's equity. ALO, this is our basic accounting equation. It relates to the balance sheet. So here we have assets, which are our economic resources, and how we acquire these assets are through debt or through equity. And then every time that there is a transaction, there is a debit and a credit. So think of this equal sign right here as debits equal credits. So here, if we invest $50,000 to open our own law office, or in our case, our own CPA firm, the impact on our accounting equation would be that we have an increase to cash of $50,000 and an increase to owner's equity of $50,000. Now, if we draw T accounts on these, we would have $50,000 is a debit to an asset, right? And then $50,000 is a credit. And again, our debits equal our credits. And so this would be our assets, and this would be our owner's equity. Now, if we take $40,000 and we borrow that from a bank, and we actually sign a note payable, then very similarly, our assets will go up by $40,000, but now our liabilities in terms of note payable will go up. So again, if we're doing our T accounts, right here we have another $40,000 to our debit, and then here we have $40,000 to our credits, and our debits equal our credits. Now, supplies costing $3,000, they were purchased on account. That's our key here. Then because they were purchased on account, that's accounts payable. And now here we're exchanging assets with liabilities. And so now here for accounts payable, we're showing an increase of $3,000, and we're showing an increase of assets for $3,000. Services performed on account for $10,000. In this case, if we perform the services, we're hoping these are law or CPA services, that would be our revenue. So here we have, and if it's on account, now on account, this would be accounts receivable. So accounts receivable is an asset, and that is our $10,000 debit. And then service revenue is part of our owner's equity as $10,000. And we'll expand service revenue. We'll also have expenses. That is part of it, and that also has a debit balance. The key to the accounting equation and to the different accounts is to know what type of an account it is: asset, liability, owner's equity, revenue, expense, and then the natural balance. Assets increase on the debit, liabilities and owner's equity increase on the credit, revenues increase on the credit, expenses increase on the debit. Once you have that all figured out and drawn out, then you're pretty much good to go. So now if we pay $5,000 to employees for their salaries, we're paying them in cash, and then salaries expense, as we just mentioned, expenses have a debit, so we would have $5,000 here, and then this is the first time that we would have our asset of cash, and we are reducing it to pay our employees $5,000 as well. Now, if we used $500 of supplies, note we had supplies as an asset account, so we would reduce that, and then we would also have supplies expense as well. Now here we paid on account, so here we paid on account the supplies vendor, here, remember, always find out what's happening to cash. So if you have cash and you paid it, that's $1,000 less. And since it says on account, it's accounts payable. So notice there's no expense here. So when you record the expense when it's incurred, and then when you pay it, we're doing accrual basis accounting, then you just debit your accounts payable. So in this case, you're crediting cash for $1,000, and then in your liabilities, your accounts payable, you're now debiting your accounts payable because you're reducing it. Remember, accounts payable increase on the credit side. So make sure you understand that you are not going ahead again and adding the expense. Oops. So our accounting equation for a corporation is stockholders' equity. So I still like to use ALO because it's owner's equity, whether the owners are stockholders or partners or sole proprietors. So just remember ALO. Assets equals liability plus owner's equity. And in a corporation, owners are stockholders. So that's just a nice, easy way to remember it. Now, when you sell stock, you have paid in capital. So you sell stock at par value, which is an arbitrary amount. And then what you pay in excess is additional paid in capital. So the par value is usually set in your stockholders' certificates or your articles of incorporation. Then the additional is your additional paid in capital. And then retained earnings is basically your revenues minus your expenses minus your dividends, and you would add your gains and your losses. So you would have revenues minus expenses equals your net income, and you're going to add that to your beginning balance of retained earnings plus net income, and you are going to subtract your dividends to get your ending balance in retained earnings. Gains or losses go in the same fashion as expenses and revenues. So make sure you have that also noted. So note that we have a double entry system, debits equal credits, and that all of our accounts relate to in the accounting equation. Then those accounts are formed in the general ledger, which is our collections of accounts, or we have a chart of accounts that kind of list all of that. And then T accounts is what I was showing you, which debits are always on the left and credits are always on the right. And debits may not necessarily mean an increase, and a credit may not necessarily mean a decrease. So a chart of accounts is a compilation of all of the accounts that we have in our general ledger. And remember, your double entry debits equal credits. And usually the trial balance is what lists all of our accounts with the debits and the credits. So here's our T account where we have our account title on the top, and then we have increases and decreases. Debits are always on the left and credits are always on the right. So make sure, and we usually annotate it as such. Then assets usually increase on the debit side, and liabilities and stockholders' equity increase on the credit side. So if you are looking at it from the accounting equation, here you go, assets increase on the debit, and the liabilities and the owner's equity increases on the credit. So your debits always equal your credits, and if you look at your equal signs, you'll note debits, assets increase on the debits, and credits, liabilities, and owner's equity increase on the credit. So hopefully that's an easier way to kind of remember debits and credits. And now this is pivotal at this point. You really need to understand all of this and how they all work, because we're just going to keep adding to all of this. So now the $40,000 that we borrowed from the bank with the note payable, right? So now we're actually digging deeper into our accounting equation. So here is our ALO, assets equals liabilities plus owner's equity. And then here we're going through our $40,000 in cash and our $40,000 increase in our notes payable. So now here is a very good schematic for you to understand how everything works. You see debits increase the assets, liabilities increase on the credit, paid in capital and retained earnings increase on the credit. So we're just expanding out our accounting equation. Now expenses, they increase on the debit, revenues and gains, they increase on the credit. So if you have this kind of memorized, then that would really help you understand our whole pretty much accounts. So We have control accounts. Usually a control account, you never book an entry to a control account. Never book an entry to a control account. A journal entry to a control account. Never. It is usually done through the subsidiary ledger. So for example, accounts receivable, accounts payable, inventory, cash, those are all common control accounts. You do not record directly, you do not debit cash, right? Or you do not debit accounts receivable. You're going to debit the customer's account through the subsidiary ledger, which is the subsidiary account. And that subledger, an AR subledger, shows you all of the customers and how much they owe you and how old that balance is, if it's current, 30, 60, 90. Same thing with accounts payable for your vendors. So make sure you never book a journal entry to a control account. Okay. Then we have permanent accounts, which are classified as our balance sheet accounts. And then we have temporary accounts, which are classified as our income statement accounts. So balance sheets, I told you, assets equal liabilities plus owner's equity. That's our accounting equation. So we know assets, liabilities, and owner's equity accounts, those are on the balance sheet, those are permanent. And then we know income statement accounts are revenues and expenses, gains and losses. And basically what temporary means is we zero them out and move them into retained earnings. Okay, so this is a good stopping point for this. We're just going to answer this question and then we will pick up on our second part of our lecture after this. So temporary accounts would not include, what do you think is not included? Hopefully you did answer accounts receivable, right? We know salaries expense, that's an income statement account. It's an expense and it increases with the debit. Accounts receivable is a balance sheet account. It's an asset account and it increases with the debit. Rent revenue, that is an income statement account. It is a revenue account and it increases with a credit. So hopefully that is what you gathered. So we will pick up right after this in our second lecture of chapter 2. So this concludes the first part of our lecture.